The best investment in the world is the investment in your mind. Hello everybody, this is Shane Choo, and today we are going to talk about the introduction to leverage and inverse ETF. And with me we have Miss Chong Lee Choo from Affin Hwang. All right, so we are very excited to share with you this thing called inverse and leverage and inverse ETF. I think for this year in 2019, there were rumors in the market that there will be newly listed leverage and inverse ETF on board on Bursa Malaysia, and finally on the 29th of November, there were 4 leverage and inverse ETF listed by the issuer Affin Hwang, okay, on Bursa Malaysia, and now you can start trading leverage and inverse ETF on the market. But it's not open for everybody. So today, Lee Choo will share with us who can trade these products and how these products can be a tool for you in managing in having a portfolio, and how you can make money in the bull market, and also how you can make money in the bear market. So now we don't have to be fearful about the bear market anymore, because we have structural warrants, we also have futures. We now have one more product, which is inverse ETF, to help us to hedge our risk as well as to profit from the panic. All right, so let me go back to the slide. So before we begin, just want to check if you can hear us and see our screen. Please raise the hand button and let me see. Okay, great. There were many of you raising your hand. Thank you very much. You may now put down your hands right now. So as usual, disclaimer, whatever we share on this webinar brought to you by Bursa Malaysia is only for educational purpose. In no way that we make any buy or sell recommendation to you. So if you decide to buy or sell any stocks or any ETF, you do it at your own risk. Okay. So today in this webinar, you're going to learn and understand what leverage and inverse ETF are, learn how this leverage and inverse ETF work and how they behave in different market environments, and then you're going to discover how investors use leverage and inverse ETF in their portfolio, and you are going to understand the risk associated with trading the leverage and inverse ETF. And today we have none other than the issuer representative themselves on board on our webinar. So it's the best chance for you to ask them any question you have in regards to the newly listed leverage and inverse ETF. So over to you, Lee Choo.
Okay, thanks Shane for the very quick and exciting introduction. Hi everyone, very good night and good evening to all of you. Hopefully you don't doze off during my presentation and you listen this out throughout the entire session. So what I'll do is that I will run through with you, like what Shane has actually mentioned, that we have listed 4 new leverage and inverse ETFs on Bursa Malaysia. So it is already a product that you can find on Bursa with any brokers. So today I will share with you how this product works, and if you find it interesting, later on at the end of the session, I will let you know how you can actually qualify to trade such products. Okay, before I go into the details of how leverage and inverse ETF works, I would want to first talk about what ETFs are. Okay, so very briefly, if you can look at the slides, ETF is actually a hybrid product that sits in between unit trust as well as shares. So the reason why it's a hybrid product is because it has attributes of these 2 types of products. First of all, ETF is like a unit trust fund, where it is a portfolio of stocks, right? It's a portfolio of bonds. It could be a portfolio of commodities. So it's a basket of underlyings instead of a single share. So because it is a fund, essentially, there is also management fee that is being charged on both unit trust funds as well as ETFs. But the management fee that we charge on ETFs are generally lower as compared to what we charge for unit trust funds. So that's also one of the reasons why it is a popular product in the US, where people want to invest into a fund structure, but they do not want to pay up high fees. So they opt for ETFs as the alternative. And because it is a fund, you can actually create and redeem units on the fly, okay? Which means that on a daily basis, if there is a lot of demand, but there isn't enough sellers in the secondary market, someone could actually come to the manager themselves to create more units. So because it's a fund, that's the good thing about it. But if you say, for example, if you buy shares, you can't typically create more units or issue more units on the fly. So that's one of the feature of ETF. And the reason why it sits in between shares as well is because ETF, as the name suggests, is exchange traded. So this fund, instead of being sold to you by an agent, like a unit trust fund, it is listed on Bursa, and you trade ETF like how you trade shares. So which means that today, if you have a trading account with any brokers in Malaysia, you can already access, buy and sell any ETFs that's listed on Bursa Malaysia. So the downside of buying single shares is that, the diversification is low. So for example, if you have 1,000 ringgit to start with for investment, you will find that buying single shares, number one, with that 1,000 ringgit, you may not be able to buy many counters. So that's also one of the reasons why people prefer buying ETF, because it diversifies your investments and lowers your risk. In terms of settlement, it is settled on T+2. Unlike unit trust, you have to pay up front. So that's the, essentially in a nutshell, what ETFs are, okay? So now that we understand the basics on what ETFs are, we'll now jump into the new products that have been listed on Bursa Malaysia, which is called the leverage and inverse ETF. So they are actually two separate ETFs. The leverage ETF actually aims to deliver 2 times the daily performance of the index. So to put it simply, if you look at the bar chart, if the underlying index goes up by 1%, the leverage 2 times leverage ETF will go up to 2% return. So that's on a daily basis. On the inverse ETF, it actually aims to give you the inverse performance or the opposite performance of the index, which means that you make money when the index drops or when the index goes down. So in this case, if the return of the index for the day is 1%, which means the index dropped 1%, the inverse ETF will go up 1%. Okay, so let me illustrate this to you later on as to how the price movement of these ETFs will be. So how does it work? How do we get? How does the fund manager actually get the 2 times exposure and the 1 times exposure for inverse? It's very simple. We actually use index futures. So as some of you may know, index futures can be quite a complicated thing, right? And if you don't understand, the good thing about this is don't bother understanding. Just invest into the leverage and inverse ETF, because the fund manager will is trying to simplify a complicated instrument to give you that leverage.
So they will do their job.
Correct. So that's why you pay the fund manager, right? And the second thing is that the fund manager also rebalances the 2 times leverage exposure and the inverse exposure daily. Okay, moving on to the next slide. So how do we do daily rebalancing, and what exactly does it mean by daily rebalancing? So if you notice 2 slides before, I mentioned that the leverage and inverse ETF is meant to give you daily 2 times return and daily inverse return. Okay, so daily rebalancing is actually similar to daily compounding interest. Okay, for example, if I tell you, or if I ask you, if you put your money into a savings account that pays you 3% per annum interest, but is on a daily rest. So what exactly does it mean? Over a year, if you compound or if you accumulate this interest or return that you earn, if you hold or rather save your money and put your money into this savings account for a year, your return is actually more than 3% per annum. Okay, and this is because on a daily basis, you are compounding your return. Okay, so daily rebalancing is similar. Essentially, what we do is on a daily basis, if I have a capital of 100, I will double that up. Okay, let me illustrate it to you in chart format so that you can understand. Okay, so how does rebalancing works for the leverage ETF? First of all, let's assume on day 1, let's say today, The fund's NAV, which is net asset value, if you don't know what net asset value is, basically it is the fund size that we own, or if you want to even try and break it down to a layman term, let's assume that this is the capital that you give to the fund manager to manage. Let's say you give me 100 ringgit, okay? So with the 100 ringgit that I get, I will now buy 200 ringgit worth of futures, okay? So I'm essentially doubling up your capital or exposure, okay? Let's assume today the index goes up by 2%. So your return for the day is 200 multiplied by 2%. So you make 4 ringgit. So what happens is that day number 2, because you gave me a capital of 100 ringgit, and today I already make a gain of 4 ringgit for you. The next day, you start off the fund with 104 capital, okay? Now this capital, on day number 2, I will double it up again for you. So 104 times 2 is 208. So by adjusting the exposure from 200 yesterday to 208 today is what we call daily rebalancing. So what essentially happens is that I realize the gain on day 1 and I add that back into your capital, and now I double up this new amount. So now your new amount is 208 ringgit. And if the index make a gain of 2%, you will make 208 times 2%, okay? There's some screw up in the sequence, okay? So what you get on the day number 2, 208 times 2% is 4 ringgit and 16 cents. So you make the 4 ringgit and 16 cents again. The fund manager, which is us, will now realize the 4 ringgit that we get from the market today, the gains, and now I'm going to add that up to become 108.16. So that is actually my day number 3 starting capital. So now that I have 108 ringgit and 16 cents, what I'll do is I will double this exposure up again to 216.3. So again, if assuming the index make a gain of 2%, 216.3 times 2% is 433. So as you can see, assuming the index make a gain of 2% on a daily basis, over a period of 3 days, you actually make more than 2% cumulatively. So for example, if you have a flat interest that pays you 2% daily, you probably just make 4 ringgit every day. But because of the compounding effect, you actually make more than 4 ringgit on a daily basis because of what the returns that you have added in back to the capital. So let me share with you the best case scenario for the 2 times leverage ETF. So assuming you have the 2 times leverage ETF, as you can see just now in the previous slide, assuming the index goes up every day by 2%, you will actually make you will actually compound this 2% over a few days, okay? Now let's assume today, if the underlying index actually goes up 1% on a daily basis. So if you do the math, let's first take a look at the red line, okay? The red line is the underlying index. So from a base of 2 ringgit, if the index goes up by 1%, you will if you double the and if you times 1%, you actually will get $2.02. Okay, that's 1% gain, right? So the index will go up 2.02. The next day, if it goes up another 1%, 202 multiplied by another 1%, you get you have now compounded to 204.02, right? And then so on day 4. So in this effect, if you look at the blue line, that will be how how the ETF price will actually move, corresponding to the index movement. So every day, if the index goes up by 1%, the 2 times leverage ETF will gain 2% return. So which is why on day 1, if you start off the NAV at 2 or the price of the ETF at 2 ringgit, the next day it will, or rather end of the day, it will go up to 204. And then the next day, this 204 will now make another 2% gain, and you get 208. So if you measure the cumulative return which is the value of or the price of this ETF on day number 4, and compare it with the 2 ringgit on day 1, the 2 times leverage ETF return would have been 6.12%. Your underlying index return would have been 3.03%. So if you just do simple math, okay, you take 303 times 2%, you should get 6.06, okay? So what you notice is that the 2 times leverage ETF actually deliver more than the 2 times underlying index. So this is the reason why we say that we aim to give you the returns, the 2 times return on a daily basis. Because when you compound this, if you hold it longer than 1 day, the returns will not be 2 times the underlying index cumulative return. Okay, so this can be a bit daunting and scary for some people who don't understand it. But all you need to do is, if you want to be clear, you can just do the math yourself, right? If you compound this returns on a daily basis, this concept is exactly the same like a savings account that I mentioned to you that is compounded on a daily rest. Okay, so essentially it's similar. Now, the second scenario that I'd like to share with you is the best case scenario for the inverse ETF. So for the leverage ETF, you want the index to go up on a daily basis, or at least trending up. For inverse ETF, you want the underlying index to go down every day, or at least if it doesn't go down every day, it must trend lower over a period of time. Okay, so let's say, as you can see in this ETF or example, the 2 times leverage ETF price versus the underlying index, it is actually moving in the opposite direction. So as the index goes lower, the ETF will go higher. Okay, so again, because of the compounding effect, say day 1, you've already made money from the inverse because the index has gone down. So remember the previous slide that I mentioned, you always add back the return to your capital and you short the market again to get the inverse position, and therefore you will increase your return and compound it over a few days. So which is why when the underlying index return over these 4 days would have gone down by 2.97%, but the inverse ETF return actually made slightly higher profit. Okay, so bear in mind the 2 times leverage ETF is multiplied by 2. It has a leverage exposure of 2 times, but for the inverse ETF, it is just 1 time, which negative 1 time, which means that if the index goes down, you make the opposite return. If the index goes down by 1%, you make 1% for the day. Okay, so but again, you have to bear in mind that there is this compounding effect that you go through if you hold it longer than 1 day. Okay, so when you invest into an inverse ETF, if some of you have shorted US stocks in the US market, or even do trade CFD, what you will notice that when you short the market, you typically press sell first, right? And then you buy back later to cover your position. But in this case, inverse ETF, it is a separate product altogether. So it is an ETF that will gain in price as the underlying index goes down. So when you trade the inverse ETF, if you think that the index is going down, you need to buy. Okay, you need to buy the inverse ETF, and then you will need to sell the inverse ETF when you think that it's time to exit. So as you can see in this chart, the price of the inverse ETF from 2 ringgit will go up to 206. So that's when you buy at 2 ringgit, sell at 206. Okay, some people get confused when I talk about shorting and getting the inverse exposure. Okay, now I'm going to share with you the worst case scenario for both the leverage and inverse ETF. So if you foresee that this scenario is going to happen, or you have this view that the market is going to be flattish, I would say avoid leverage and inverse ETF at all costs, because the probability of you losing money in such a market environment is extremely high. Okay, because of the compounding effect, right? you basically, if you get the direction right, you gain profit. And when you get the direction wrong, you are essentially doubling up your losses, and then you would immediately have to net off that losses already, okay? And then you will start off the next day with a lower base. So as a result of this compounding, it actually is not so good for the investor, okay? So let's run through this chart very quickly. So if you take a look at the underlying index movement, it is volatile, up and down, but at the end of the fifth day, on the fifth day, it just ended up slightly above, which is 0.47%. But what you can see is that both the leverage and inverse ETF actually lost money. Okay, the inverse ETF made losses of 6%, and the leverage ETF actually made a loss of 7.46%. So in this market environment, a flat market is the worst for leverage and inverse ETF. So again, if you have a view that the index will be flat over this period, then the advice or rather the recommendation is do not hold or invest into the leverage or inverse ETF. All right. Now, so after sharing with you how leverage and inverse ETF work, now let's talk about the two, or rather the four new leverage and inverse ETF that is available on Bursa Malaysia. So the first one is called the Trade Plus NYSE FANG Plus Daily Leverage Tracker, 2 times leverage tracker. The stock code is 0830EA. So if you want to look up the stock code to check the historical trading for this, you could already do that. The second ETF that we launched is called the Trade Plus NYSE FANG Plus Daily Negative One-Time Inverse Tracker. So this one has a stock code of 0831EA. So if you are bullish of the index, you will go for the 0830EA, which is the leverage tracker. And if you are bearish on the index, or if you expect the index to drop, you should go for the 0831EA. Okay. So let's, for ETFs, actually what is important is understanding the index, because essentially when you talk about investing into ETF, you are essentially investing into the particular index. So this New York Stock Exchange FANG Plus Index is an index that comprises of 10 constituents. So if you take a look at the right-hand side of the slide, the 10 constituents are basically your FANG stocks, right? Facebook, Amazon, Apple, Netflix, and Google. And because it's FANG plus, so it's FANG plus friends, okay? So who are the friends? The friends are Alibaba, Baidu, Tesla, Twitter, and Nvidia, okay? So these are the friends of FANG, okay? And they are essentially the tech giants, okay? That gives you a growth exposure to technology and tech-enabled companies, okay? So in a typical index, usually they use what we call market cap weight, market cap weighted index. So what it means is that if, let's say, Facebook has got a huge market cap, it will be assigned a huge weightage. But in this index, the difference is that all these 10 stocks are equally weighted. So which means that Facebook gets 10%, Apple gets 10%, Amazon gets 10% allocation. And on a quarterly basis, the exposure, because the price of these stocks could have moved up, that caused the weightage to be off a little bit. So what happens is that on a quarterly basis, the index provider will then rebalance the index to make it all 10% weightage again. Okay, so that is what the index provider will do. Okay, now the second pair of leverage and inverse ETF which we have launched at the same time actually is based on the HSCEI index. Okay, some of you may have heard of the Hang Seng Index. Hang Seng Index is the brother or the cousin of our KLCI index. Okay, essentially KLCI is your top 30 largest companies in terms of market cap on Bursa Malaysia. Hang Seng Index, which is a very popular index that tracks the Hong Kong market, is the top 50 largest company on Hong Kong Stock Exchange. HSCI is called Hang Seng China Enterprise Index. So if some of you have heard of what is called H shares, essentially HSCI is Chinese companies that are listed in Hong Kong Stock Exchange. Okay, so some of you would know that China is quite a closed economy. So some of these companies who wants to raise funding have decided not to list on the mainland China because international investors in the past could not really access the mainland China equities market or stock market. So which is why for companies who wants to raise funds out, and get international participation, they would like to usually choose Hong Kong Stock Exchange as the secondary, or rather their first option to list a counter or a company. So in this HSCI index, they basically track the top 50 largest China company, but listed in Hong Kong. So I share with you some of the top 10 of this index. Because it is a very conventional index, just like our KLCI, a bulk of it will sit with financial or banking stocks. So for example, you have China Construction Bank, ICBC Bank, Bank of China, CM Bank in this index. You also have China Life, Ping An, Sinopec, Tencent. Okay, so these are very common and big Chinese companies listed in Hong Kong. Now let's take a look at how the 4 ETFs have done over the course of 3 weeks since we listed. We actually launched the fund earlier, which is on the 26th of November, but we only listed the fund on Bursa on the 29th of November. Okay, so this price that you see is actually our end of day NAV, okay, which is the fair value of this ETF. So if you take a look at how the ETF has performed versus the benchmark, which is the 2 times leverage FANG index, you can see that on a daily basis, we have been tracking the benchmark quite closely. So that is very important for an ETF, because you don't want to buy into an ETF or invest into an ETF to realize or find out that it actually doesn't move in accordance to the benchmark. So in this case, this chart is to illustrate to you that it does move. And if you take a look at the cumulative performance over this 3-week period, so the chart on top talks about the daily performance. So remember, I said earlier, the objective is to give you the 2 times return daily. So on a daily basis, we have been tracking it. But because over a cumulative basis, you do not get the exact 2 times, so it will run off slightly because of the compounding effect. Okay, so the underlying index has actually dropped 0.65%. The FANG Plus index has actually dropped 0.65%, but the 0830 EA, which is the FANG leverage tracker, has actually gone down by 0.82%. This is as of 9th of December. The case has actually changed today because FANG has shot back up. Now the FANG daily leverage tracker is on the positive side. It is actually trading at $4.20. As at this point, I believe the price of the ETF was slightly below 4 ringgit. Okay, now moving on, if you take a look at the inverse tracker, so as you can see, the chart on top talks about the daily performance, and it is really to illustrate to you that on a daily basis we are tracking the benchmark, which is the inverse performance of the FANG index. And on the bottom part, if you take a look at the cumulative performance, you notice that the trend is on the opposite, right? It's like a mirror reflection. So what you can see is that the FANG index over this 2-3 weeks period has actually dropped 0.65%, but the FANG daily inverse tracker has actually made a profit of 0.35%. So as you can see, over a cumulative period, even though the underlying index has gone down by 0.65%, it does not mean that you will get 0.65% return on the inverse ETF. So this is really due to the compounding effect that I mentioned just now as a result of the daily rebalancing. Okay, now let's take a look at the HSCI daily leverage tracker. If you take a look at this one, again, the chart on top is to illustrate the daily performance that we have been tracking it quite closely. And the second cumulative return tells you that if I compare the 2 times leverage tracker, which is in blue line, versus the Hang Seng China Enterprise Index, the HSCI is not the leverage benchmark that we talk about, yeah? So the index has gone down by 2.08%, but if you multiply that by 2, it's actually 4%, right? But as you can see, the 2 times leverage tracker did not make a loss of 4%, but instead it lost more, which is 5.37%. Again, this is due to the compounding effect, okay? And again, the case has totally changed for now because Hang Seng China Enterprise Index over the last week, or rather a couple of days ago, has also shot up. So now actually the HSCI leverage tracker has, you know, gone back up in the positive zone. And if you take a look at the daily inverse tracker, HSCI, again, it's the same thing. What I'm going to try to tell you is that the underlying index make a loss of 208%, but in this case, the HSCI daily inverse tracker has gone up by 2.3%. So in this case, you will see that the HSCI daily inverse tracker actually do slightly better than the underlying index. So that is also because if you can see the trend of the HSCI, it has more or less gone down more, whereas the FANG index was more volatile. Okay, so you kind of like shave off more returns as a result of the compounding because of the volatility. Okay, now let's dive into how leverage and inverse ETFs are being used in whether by investors in different jurisdictions. So leverage and inverse ETFs are totally not new products. They exist. They're very popular in the US, of course. They are also over in Asia. They are only popular in Hong Kong, Japan, Korea, and Taiwan. Okay, so what people like about trading the leverage and inverse ETF is that if you have a bullish view, you will then buy the 2 times leverage ETF, because you would want to, if you think that the market is going on an uptrend and you want to double up your investment, of course you can go to the bank and say, can I please apply for a margin financing? But applying for margin financing means that you have to pay for your financing costs, and there could be a lot of requirement that you may need to fulfill. And by the time you open the account and get the financing, maybe the market has already run off, right? So of course, unless you have a ready account. So if you don't, buying into the leverage ETF will help you get a very quick exposure if you think that the market is trending upwards, short term or even long term. Okay, if you have a bearish view, what you can do is that you can buy the inverse ETF, because the inverse ETF will make money when will give you the profit when the index goes down. So if you have a bearish view, dump the 2 times leverage ETF and buy the inverse ETF instead. And again, to reiterate, if it is a sideways market, avoid L&I ETFs at all costs unless you are very confident and know how to range trade. Okay, so which means that every time it hits the upper band of the side range, you will have to buy inverse, because you expect it to fall down, to the index to come down, right? So and then if you think that the index is at the bottom of the sideways range, then again you can buy the leverage ETF. So if you are not great at timing the market for sideways market, because it's really difficult to catch, then the suggestion is, forget about L&I ETFs, right?
Yeah. So in short, if during a strong uptrend or strong downtrend, you can hold.
Yeah.
But during a sideways trend, you don't hold, but
Correct.
do daily trading.
Yeah. If you can do daily trading, that'd be great. If not,
avoid.
Just avoid. Yeah, it's for risk management. Okay. So why leverage and inverse ETFs are maybe suitable for you, for those of you who are listening. So first of all, for the leverage ETF, if you have a strong view that the index is on an upward trend, and if you want to magnify your returns of up to 2 times, but not more than 2 times, then the 2 times leverage ETF may be suitable for you. So what I'm trying to emphasize here is that there are, I would say, similar products out there, like structured warrants, which could potentially give you more than 2 times leverage. The gearing is easily, 10 times, sometimes 13 times, all the way up to 20 times. So if you have a very, very strong view, okay, the fastest way to profit is actually to go to the structured warrants market. But of course, if you don't understand structured warrants, also, try to avoid, because structured warrants can be very complicated with expiry, with time to the expiry and the value of time value of money and things like that, right?
Intrinsic value.
Correct. So there are a lot of complicated terms. If you don't understand, again, don't jump in, right? So I would say that the leverage ETF is more suitable for investors who want to get more than 1 time return, but you still want to manage risk, okay? Because as much as the warrants can give you 10 times gearing, 20 times gearing, it also means that you can lose 10 times and 20 times very quickly. Whereas for this case, 2 times, your losses will just be 2 times or slightly more than 2 times because of the compounding effect. Inverse ETF, if you have a strong view that the index is on a downward trend, then inverse ETF could be the product for you. Or if you want to profit from market decline, but you do not want a leverage exposure. Again, there are also put warrants on Bursa Malaysia that you can invest in, which gives you the similar exposure where you profit from market declines, but those are, again, highly leveraged products, whereas the inverse ETF just gives you 1 time exposure. Okay? Or if you want to hedge market risk, then you can also invest into the inverse ETF. So let's talk a bit about hedging. Okay? Some of you may hear the word hedging, on and off, and then you'll be wondering what exactly is hedging. So hedging, essentially, to put it simply, is basically offsetting your losses by basically buying another instrument or product to offset the loss from another portfolio or product. Okay, let me give you an example in this case. Let's say you have invested into the HSCEI ETF. Okay, there is such an ETF listed in Hong Kong. So I've actually pulled out real products for you. So let's say you invest into HSCEI ETF in Hong Kong. During this period when the market is falling, what you can see is that your HSCEI ETF would have made a loss of 7.28% over this period. Sometimes as an investor, you think that the HSCEI ETF, for example, is something that is worth holding for long term, right? But you want to try and smoothen out your return and try and manage your risk, right? Because you don't want to see your portfolio drop 7.28%. So what you can do is you can buy a HSCEI inverse ETF, because the HSCEI inverse ETF gives you the profit when the HSCEI index goes down. So when you do that, that is essentially called hedging, okay? Because the profit that you make from the HSCEI inverse ETF, which is 3.94, is then used to knock off the loss of holding the HSCEI ETF, which is 7.28%. So again, in this case, you will realize that it is not really a perfect hedge, which means that the returns, the losses and the return is not exactly, it doesn't match entirely, but it is still a good buffer for you to suffer lower losses, right? If I may put it that way. So essentially, hedging is used typically when you want to continue holding the stocks, but you want to try and manage the downside risk. Okay, so very simply to conclude, what is important when trading L&I ETFs? First of all, volatility of the index, of the underlying index, is very important. The higher the volatility of the index, the better for the leverage and inverse ETF. Okay, because leverage and inverse ETF sometimes can be used as day trading products. Okay, so imagine if the underlying index only moved 0.5%. If it goes up by 0.5%, you leverage that 0.5% up, it's just 1%, right? Net off your transaction costs, it may not really be well worth your time. Okay, so you need the index to be volatile. Okay, secondly, you need a trend. The stronger the trend, the better for L&I ETFs. So remember the chart that I showed you in the very early stage, where if you, because of the compounding effect, if it's, let's say, if it's a strong uptrend, okay, when it's a strong uptrend, if the index continuously go up, for a couple of days, you will essentially compound your return over time. So you get more than the actual return of the index. Thirdly, you need to have a strategy, because leverage and inverse ETF can turn very, very quickly. Like for example, when I prepared the slides last week, I show you up to 9th of December. At that point in time, the leverage ETF was losing money. The leverage ETF was losing money. But yeah, very quickly, within like a week, you see the reverse happening. Okay, so that's why you need to have very disciplined entry and exit strategy, because if you are trading, that's very important. So what I want to say is that there are two things. First of all, if you are very confident that the market is on a uptrend, okay, but it can be volatile because it doesn't make sense for index to keep going up every single day, okay? So then there may be pullbacks in the market, but generally, if you expect the trend to be upwards, then you can hold the leverage ETF for longer than a day, even though there could be compounding that is taken into effect. Sometimes your returns get shaved off a little bit, but you are still well above the one-time return. Okay. But on the flip side, if you want to trade, okay, short term, then you really need to have very disciplined entry and exit strategy. Okay, which means that the minute you see that HSCI, for example, initially you have an inverse position, but very quickly because of the news flows, when President Trump said that the trade war is finally more or less done, of course, the details are not out, but at least that announcement actually helped prop up the market in general. So if you see that, you need to quickly turn your position, sell down your inverse, and then move into the leverage ETF to get exposure. So last but not least, I'm going to run through the risks of trading such products. These slides can be very complicated and it looks like, wow, so many risks. So first of all, in terms of long-term investment holding risk, so what essentially long-term investment holding risk means is that there is compounding effect. So 2 times daily does not mean 2 times over a period longer than a day. Okay, put it simply. Leverage risk, when you invest in the leverage ETF, as much as you can double your return, you can also double your losses. Inverse performance risk is when you invest into the inverse ETF, but the market turned against you, it went up instead of down, so you make losses. Okay. Futures investment risk, because the fund invests into the futures contract, there is a risk that you have to bear. What risk that would be? For example, the futures market may not move exactly as per the index. Okay, so let's say the HSCI index could have made a gain for the day of, let's say, 1%, but the futures market can actually do slightly better or lower than this 1%. Okay, so that is some of the risk that is associated with futures. And trading hours difference risk, this is in relation to the FANG plus ETFs. Why? Because when we are trading the FANG ETFs during the Asian hours, which is when Bursa is open, the US market is closed. So nobody is pricing the Facebook stocks, you know, Amazon, Apple, Netflix, etc. Okay, so as a result of that, the ETF will likely not move in prices during the entire day. Okay, so say for example, if it's at 4 ringgit, it will be traded at 4 ringgit throughout the day. But when the US market opens tonight, and assuming if the FANG Plus index close up, say close up 1%, the next day when the market opened, the FANG Plus leverage ETF would have jumped up in price, the opening price, corresponding to the closing last night. So this is what we meant by trading hours difference risk. Okay. Now we compare the different instrument between the leverage and inverse ETF, etc. Of course, you know, trading structured warrants and futures contract gives you more than 2 times exposure, leverage exposure or inverse exposure. Whereas the leverage inverse ETF is only capped at 2 times for leverage, and inverse is only capped at -1 time. You don't need margin account, there is no expiration date, so you can hold it as long as you want, provided that you are, you know, well aware of the long-term investment holding risk. And at the same time, you can't possibly lose more than what you have invested, unlike trading with margin account as well as futures contract. So this chart is really to show you how the HSI index has performed versus a HSI warrant and a HSI 2 times leverage ETF that is listed in Hong Kong. Okay, so as you can see, over this period since end of July till December 11, the HSI index has only gone has gone down by 4.66%. If you have invested into a HSI warrant, okay, you would have made losses as much as 71.5%. Okay, if you have invested into the 2 times leverage ETF 7205 Hong Kong, you would have made a loss of 11.17%. Okay, so this is really to tell you that high risk, high return. Okay, if you want to take if you want to be highly leveraged and invest into warrant, you could make that, you know, if this is a flip on the positive side, you could have made 71% return, but you could have made that 71% losses as well. Okay, so this is just to illustrate that. And this slide is to illustrate to you that even though the objective of the ETF is to give you the daily performance, but it doesn't mean that you cannot hold the ETF for long term. Take, for example, if you were to hold this ETF for almost 1 year, okay, so imagine you bought the Hang Seng HSI ETF, 2 times leverage ETF. So over a 1 year period, the Hang Seng index has gone up 4%. Okay, the Hang Seng index 2 times leverage ETF has actually gone up by 6.99%. So you don't get 2 times exactly, because 4 times 2 is 8, right? So you don't get 8%, but you still get a decent return, which is 6.99%. So the key is, if you want to hold long term, just be aware that you will get returns slightly better than 1 time, probably slightly worse off than the 2 times, but it's still better than buying 1 time of the index. Okay, and that's provided if the market is trending and not sideways. So last slide for today, how to qualify to trade. So leverage and inverse ETFs are new in the market. So therefore, the exchange has some criteria before you can trade leverage and inverse ETF. So the first criteria is you must be a sophisticated investor. Sophisticated investor means that you have to have 3 million net worth or 350,000 annual income. Okay, so if you can't meet criteria A, move on to criteria B. If you have a margin account with any brokers in Malaysia, you can also qualify. If you don't have, don't worry, move on to C, okay? C says that if you have executed at least 5 transactions in structured warrants in the past 12 months, you can also qualify to trade. And if you don't meet A, B, and C, don't worry, you have criteria D, okay? So what does criteria D says? Criteria D says that you have to utilize a performance simulator on our website. So the link is given here. You can go to the tradeplus.com.my and look for the L&I performance simulator. Basically, this simulator just tells you that, you know, in the market goes up, you know, how the NAV or rather the fund will be priced in that sense. So it's actually historical return of the product, okay? And at the same time, you must go to Bursa Marketplace and look for, the link is given there, and look for the videos that talks about leverage and inverse ETF. So the videos that is put up more or less, you know, is what I present to you today, okay? Of course, you cannot say that after attending this webinar, you qualify yourself as having, you know, gone through the video. It is advisable that you go through the video on Bursa Marketplace. So once you have done the performance simulator and the e-learning tutorial, basically it's just to watch the video, then you can tick on this checkbox and say that you now qualify to trade. So what you need to do is that you need to contact your broker to request for the declaration form in order to qualify to trade leverage and inverse ETF. So personally, I've tried trading the ETFs. So what happens is that if I've not signed the form, the broker will reject my order. Okay, but it never tell me why, unfortunately. So you have to call the broker up and ask them for the form. Once you sign the form, you can then start trading leverage and inverse ETF. Okay, perhaps one last point that I want to address before I move on to take question and to take any questions from all of you is that if you take a look at the trading volume of these ETFs over the past 3 weeks, the trading is very light. In fact, some days there could be 0 trading, okay? But don't worry about the 0 trading. Why? Because we have market makers in place, okay? So these market makers are investment banks which we appoint to provide liquidity in the market. So essentially, their commitment to us is that they have to quote a bid and an ask price. If you monitor, even if you don't trade, try and monitor our ETFs on a daily basis. The price of the ETF actually correspond to the changes in the underlying index. The only thing is that even though there's no trading volume that is done, it doesn't mean that you cannot get in and out of the market. You can, because our market makers are there ready to buy and sell from you. Okay, so no trades done, no volume does not mean 0 liquidity for ETFs. So this is one of the misconceptions that I've been trying to, you know, bring across to many investors via our other roadshows and seminars. Okay.
Yep, definitely.
Yeah.
Well, I guess Lee Choo has done a great presentation to you about what leverage and inverse ETF are, who can trade them, and how you can qualify for them. Even if you are not a sophisticated investor, even if you don't have a margin trading account, even if you have not traded any exchange trade derivative or structured warrants before, so long that you undergo the tutorial and you go to the performance simulator on tradeplus.com.my, you can still qualify to trade the leverage and inverse ETF. So now we have come to the question and answer session. You can write down your question in the question box. The speaker will attempt to her best capability to answer all questions. Okay, so but please write down in full sentences so we can understand your questions. All right, so now the first question is, who is the fund manager for this ETF?
Okay, the 4 ETFs that I share with you, the fund manager is actually Affin Hwang Asset Management. So I'm from Affin Hwang Asset Management. We currently manage 54 billion worth of unit trust funds. So the manager is us, right? Okay.
So they have vast experience managing funds.
Yep.
Don't worry. Okay, they have also listed ETF before on Bursa, so they are well experienced in running ETF. So can you tell us about the spread of this ETF?
So like I mentioned, investing into ETFs, you don't have to worry so much about liquidity because there are market makers that exist to market make. For the HSCI and the FANG ETF, if you have been monitoring, if you have not just added to your favorite list, on your trading platform, I've done that to monitor the pricing. The spread that the market makers quote currently is 1 cent. So the HSCI leverage and inverse ETF is trading at we listed it at 2 ringgit. So the difference, bid and ask price is 1 cent difference. So for example, if let's say the bid is at $2, the ask will be at 2.01. Okay, both leverage and inverse is the same. The FANG leverage and inverse ETF is slightly more expensive. It is we listed it at 4 ringgit. So again, it is also for FANG ETF. I think the market makers are pricing it slightly wider. It is at 2 cent now. Sometimes you can get 1 cent. Otherwise, it's at 2 cents difference. So it could be $4 and 4.02.
All right. Thank you so much for clarifying about the spread of this ETF. So the next question is, am I right to say that for the FANG Trade Plus FANG Index FANG Plus Index ETF, it will always get up and get down because during our daytime, which is the US nighttime, we will have to correspond to the changes in the US market.
Yeah, so the ETF will always open up or down depending on where the market move. So of course, that is also one risk that investors take, because today, let's assume, right, you take a leverage position on the FANG index. Okay, you think overnight when the index is open, the FANG stocks will rally, right? And as a result of that, our president, US President Donald Trump likes to tweet, right? So sometimes when he made a tweet and something happened to the US market at night, right? So as an investor, because you took a leverage position during Bursa trading hours, the unfortunate thing is you can't really rectify your position. So the next morning, for sure, when you wake up, when Bursa opens, the price of the 2 times leverage ETF would have dropped.
All right. Yeah. So if you think that Trump is going to tweet good news, then you buy leverage ETF first. If you think Trump is going to tweet bad news at night, then you buy the inverse ETF first.
Yep, that's right.
All right. So during our daytime, this Trade Plus FANG ETF will not move much,
yeah,
correct? Because the US market is closed.
Correct.
But it tracks the futures, right?
It does. It does.
So, but futures will have very little movement.
Slight movement as well during, very slight.
After trading hours.
Yeah.
Okay. So the next question is, am I right to say that the Hang Seng China Enterprise Index ETF underlying is Hang Seng China Enterprise Index futures? Which underlying is a Hang Seng China Enterprise Index?
Yeah, I think it's right. So the HSCEI, okay, I'm not too sure whether you're talking about the HSCEI leverage ETF. If you're talking about the HSCEI leverage ETF, then the answer is yes. The underlying is the HSCEI futures. So the price of the ETF move in accordance to the HSCEI futures movement. So if you actually notice just now, I mentioned that there is a futures investment risk, right? Which means that the futures price may not move in accordance to the underlying index, which is the HSCEI index. So, but what we are tracking is the futures. So therefore, you are right to say that the underlying is actually HSCEI futures.
So would you, do you trade a basket of futures or you trade?
No, just the HSCEI futures. So
is there a specific month?
Okay, for HSCEI, we do the current nearest spot month, whereas for the FANG is a quarterly contract. So it's March, June, September, and December.
So right now it's December. Which month are you tracking?
December.
December.
So come the end of 1 or 2 days before the last trading day of the futures contract, the fund manager will do the rollover for you. So you don't have to worry about expiry. We will do the rollover to the next months, or either the quarter or the month's contract.
All right. So the next question is, can you please share about the charges for this ETF?
Yeah. So yeah, sorry, I didn't mention about charges. If you like to find out a lot more information on this ETF, you can go to our website. It's transparent. Tradeplus.com.my. We have the charges there. We tell you who the market makers are. We tell you who the participating dealers are, where you can create more units and redeem units. We even tell you on a daily basis what the basket is comprised of. So it will tell you the fund size, everything. Okay. So what was the question again?
Question, what are the charges?
Charges. Okay. The charges that we charge for management fee is 1% per annum. So which means that if you on a daily basis, it is actually taken off from the price of the fund. Let's put it that way. So because it works exactly like a unit trust fund. So if you know how unit trust fund works, on a daily basis, the fund manager will calculate the management fee that is due, and it will then be accrued from the fund. So let's take, for example, if you have given us the fund manager $100 worth of capital, when I manage this investment for you, every day maybe I take out like 50 cents, example, okay? Maybe every day I'll take out 50 cents from it, okay? So if you have profit for the day, I will net off 50 cents on a daily basis. So which means that if you buy and sell, if you hold it within the short period, the charges that you pay essentially is prorated. So even though we charge 1% per annum, you don't pay the 1%. You just pay 1% divided by, let's say you hold 3 days, you're just paying 3 days worth of the 1% per annum charges. Okay, so these are all, how would I say, these are what we call indirect charges that are net off from the fund directly, and it is all reflected in the price. So as an investor, of course, let's say if I charge 1%, assuming the price don't move at all, underlying is 0 flat, by end of the year, you will see the price decline by 1%. So when you trade, it's all reflected in the price.
So in other words, if you invest 100 ringgit into this fund, in 1 year, you may end up paying 1 ringgit asset management fee.
Correct.
Only 1%. So if you compare, am I right to say that if you compare equity funds, this is considered on a lower end compared to the other actively managed mutual funds?
Yeah. So different mutual funds charges differently. Typically, an equity fund will charge somewhere between 1.5 to 2%, depending on the fund house as well. Bond funds typically is lower, 1%,
Money
right?
market fund is
Money market fund is even lower, like 0.3% and all, right? But for this leverage and inverse ETF, because of the daily rebalancing that the fund manager has to do, that's why the charges is slightly higher, which is at 1%. If you compare it to Taiwan, Hong Kong, Korean market, it is more or less there in terms of the the charges. Like it's quite comparable. If you compare that to, let's say, the equity ETFs, it's even lower. For example, it's higher. The leverage ETF is higher. Like for us, we have 2 ETFs currently: gold ETF and China ETF. The gold ETF we only charge 0.3% per annum. The China ETF we only charge 0.5% per annum. So it's a very low fee product.
Yeah. So the leverage and inverse ETF charges slightly higher fee than the passively managed ETF because of the daily work that the fund manager need to do to rebalance the portfolio and to monitor and mirror the performance of the benchmark. That's why it's like charged slightly higher.
And other than that, you also have to take note that you pay your standard brokerage fee. So because it's traded on stock exchange like shares, so you just pay your standard brokerage fee, clearing fee. And the good news is stamp duty is actually waived all the way up to end of 2020. So any ETFs that you trade in Malaysia that you buy and sell, stamp duty is waived automatically.
Which was announced, I think, last year.
I think, yes.
Last year. All right. So let's take a look at the next question. Let me see. So the next question is pretty long. So let me just read. For 2 times leverage ETF, let's say that the KLCI is up 10%. It does not guarantee this ETF get me 20% in return. Am I? Is the question?
Yeah. Okay.
All right. And then the second question is, it might have bigger chance having lesser return percentage than a 20% because when the market maker give liquidity, is the spread close or far?
Okay. When you talk about the 10% return, I think the question that I'll need to ask you is that, are you talking about 10% cumulative return, or are you talking 10% on a daily basis? Okay, because the fund manager tries our very best to give you the 2 times return. Of course, there's no guarantee, that's for sure, but it will be close enough. So which is why in my earlier slide, I actually show you the daily tracking of this of our ETFs versus the benchmark, okay, to show that we are actually tracking very, very close to the 2 times of the benchmark. So yes, the answer to that is there is definitely a risk that investors have to take, because the fund manager, as much as we on our best effort basis try to give you that 2 times return, sometimes we may not be able to give you that the 2 times exactly return. That's one. The second thing is that if you talk about the liquidity, because the spread, right, is just 1 cent difference that our market makers are quoting. So if assuming you get 10%, you minus off this 1%, this 1 cent difference in terms of your spread, I think you still make a fairly decent return.
Okay, so how about when the market maker gives liquidity, is it spread close or far?
It's close, so it's 1 cent difference. Okay. So like I said, $2 and 201 cents.
Okay, so next question is, are ETFs suitable for long-term investment?
ETFs are generally suitable for long-term investment, but not for leverage and inverse ETF, because leverage and inverse ETFs are more trading products. But like I showed you just now, right, HSI index, you typically can hold the ETF for longer than 1 day. In the previous example that I showed you, you actually would have held the ETF, the leverage ETF, for close to 12 months, and yet you still get close to two times return, but there's some discount because of the compounding effect. So what's important is that if you have a strong view that over a long term this ETF will continue to trend up, then I would say holding the ETF, this leverage ETF, for slightly longer term will not be an issue. Again, don't be caught by the sideway trading, sideway market. That's all that I need to warn you against. But other than that, as long as you are aware of the effect of the compounding, holding the leverage ETF for longer term, or even the inverse ETF for longer term, should not really be an issue. But most importantly is the trend. It needs to be in the right trend.
Yeah. If you think it's a bullish trend, then go leverage.
Correct.
If you think it's bearish trend, go for inverse.
So if you don't have that appetite or don't have the time to monitor, then maybe leverage and inverse ETF may not be so suitable for you. Perhaps you can just look at those normal ETF which just plainly track the index. Like for example, we have an S&P New China ETF. You can check that out. If you like the China story, the China market, you can always look at that, and those products will be suitable for you to hold long term because there's no leverage involved, there's no shorting. So buying and holding long term, go for those simple ETF, not leverage and inverse.
Yeah. So if you are, in short, if you are a conservative investor, then go for the ETF.
Yes, the simple ones.
The simple ones. If you are a trader or more sophisticated investor, you can use inverse ETF or leverage ETF to achieve the objective, be it in hedging, be it in give you a magnified returns, but you need to pay close attention in the market. Because the compounding effect can work in your favor,
Yeah.
especially during the trending period, and it can work against you during a sideways market. All right, so this is very, very important. Okay, that's why I need to emphasize many times.
Yes.
All right, so the next question is, who are the market makers for this ETF?
So currently for the HSCEI Leverage and Inverse ETF, we have two market makers. They are Affin Hwang Securities as well as Malacca Securities M+. For the FANG Leverage and Inverse ETF, we only have M+ as our market maker. So this information again is available on our website. So don't worry that one day liquidity is out, because there is a requirement by the Securities Commission that in order for the issuer to continue to keep this product alive, I need to maintain minimum one market maker. So when I run out of market maker, or if suddenly M+ wakes up and say that, hey, I'm going to quit on you and not be your market maker anymore, I'll be in trouble. So we will have to quickly find a new replacement market maker to market make. So we are actively sourcing and onboarding more market makers. So which is why you can also, if you want to know, you can check our website frequently. So because all the information is there. So as and when I have more market makers, I will add it up and put it up on the website.
All right. So the next question is, assuming that Hang Seng China Enterprise Index spot month moved up by 1%, will your ETF on the Hang Seng China Enterprise Index move up 2% to reflect the 2x leverage?
Yes, it would be on a daily basis, yes. So if you don't believe me, if you don't trust me, just again, add the the 4 products onto your favorite list and just take a look at the price movement. It has been corresponding well because personally, as issuer, we do monitor the price that our market makers quote. So if we notice that the price is off, sometimes we will call the market makers and check what's going on. Yeah.
Okay, if I may ask, because I think all ETF will have this kind of risk of the margin tracking error. So yours should be very, very minimal.
Yeah.
Okay. So now, just now you were talking about the possibility of, because you're monitoring the market maker to make sure that the price is fair. And then may I ask you a more advanced question? Is like that involve the authorized participant creating the unit and redeeming the unit. Is that how do market makers ensure that there's no arbitrage happening?
Okay, I think one of the very the questions that investors will ask me is that, how do we ensure that the price that the market maker quotes is close to the NAV of the fund, right? That's very important to us, okay, as well as investors. So number one, we do monitor our market makers very, very closely. The minute their pricing is off, they will first usually get a call from us first, okay, because we have a contractual obligation or contractual obligation with them, and they cannot turn against what they agree to do for us, right? So other than that, you can also take a look at, because ETFs, right, you can create units on the fly. Today, if let's say you want to buy more units, but there's not enough liquidity, you can always come to the manager to create more units, okay? But coming to the manager in the primary market means you have to have a big sum or big size. Different ETF will have different requirements. Just give you an example, let's say the gold ETF is 500,000 units. That's almost 1 million in value before you can come to me to create more units, okay? So what happens is that if you come to me to create units, I will always sell to you at the NAV of the fund. Let's say the NAV of the fund is at $1, okay? If the market maker is actually quoting a price at $1.50, for example, right, it's far off from the NAV of the fund. So what an investor could have done would be they could have arbitrage, right, opportunity where they can buy in the primary market from me at $1, sell it in the secondary market at 150. So it's actually a clean profit. But of course, it's not so easy, right? It can be a bit complicated because of the settlement timeline, the operational issues and all, right? So it may not be so straightforward, because the minute you come to me to create, it doesn't mean I give you the units immediately, right? And you can't really sell it down in the market. We are not, Bursa is not there yet. But in the US market, it is, very efficient. Okay, so when it's efficient, all the more the arbitrage opportunity is even greater, and therefore the market makers will have to, in a way, ensure that they price it very close to the NAV, because that will mean that they are actually losing money if there is such arbitrage opportunity. So what will happen is that if, assuming such arbitrage opportunity appears, a big institutional investors could essentially just keep repeating that same process. Okay, so the free money cannot come forever, right? Somebody has to give and somebody has to take, right? So what happened is that if you think about it, the market makers, let's say this investor, let's say you are the investor, you already bought the units from me at $1, right? And now you go to the secondary market, you offload to the market maker. So market maker would have bought back from you at 150. The market maker will not forever sit on these units at $1.50, right? They may not even want those units. They may come back to me, the manager, and say that, hey, can I please redeem these units and cancel it off? So when they come to me and cancel it off, I will pay them back at $1, because that's my fair value, right? So which means who is making the loss? The market maker, right? Because they bought at 150 and they have to sell it back to me at $1. So if they make losses, and they would have realized that, hey, something is wrong, right? So they cannot keep buying back and quoting 150 anymore. They have to correspond to the NAV of the fund.
Can they sell you at 150 and then buy from you at 90 cents?
Yeah,
that was a big spread.
That could happen as well. But that would also mean, again, there is always that arbitrage opportunity lah. So market maker's job is essentially trying to close that gap and price it close to the NAV.
Yeah, if the market price is above the NAV, then there will be people who arbitrage by going to the primary market to buy the unit and sell it on the secondary market. But if the market price is lower than the NAV, people will buy from the secondary market and redeem it from the primary market, just to arbitrage. But this is a bit more complicated and advanced, unless you are a very, very well-informed, sophisticated investor with huge fund, then probably you can do that, But well, this is just a question out just to get everybody informed about this, a bit more advanced question. So the next is what is the best platform to invest in a foreign ETF as well as local ETF? Okay, so that's the question. But for me to answer that, local ETF, you can get it from any local banks, local stockbrokers, okay, local investment banks and local stockbrokers. If you want to purchase a foreign ETF, you can also go through the local stockbrokers. They provide a facility for you to trade the foreign ETF, as well as the foreign inverse and the leverage ETF.
Maybe just to add on, just for sharing purpose, sometimes many investors tell me that they don't want to buy the local ETFs, they prefer to buy the overseas ETF. If you think about it, when you invest into the overseas ETF, you incur more charges, right? For example, if you buy the ETF in US, you use a local broker, let's say, the local broker will charge you one layer of local brokerage fee rate. And then when you go to the foreign brokerage, they will charge you another foreign brokerage rate. And on top of that, you also get charged on the conversion, right? Because you need to convert your ringgit to US dollar. And even though it seems like, it doesn't cost you anything, converting your money easily costs you a 3% spread, right? It is something that you cannot see, but it exists. That will also mean that sometimes you may have made money in your ETF in the US market, but the minute you convert back, you could have lost from your FX. And sometimes investors are too focused on, say, looking at the spread of the local ETF and not taking into consideration all these other additional and hidden charges that exist in investing into overseas ETFs.
Yeah. So in short, wherever listed locally charges you lower transaction fee compared to wherever listed in the foreign markets. Okay, so that's what we have here as a Malaysian. These are the facilities that we have that can enable us to invest in stocks locally as well as overseas. If you go through a local brokerage firm, then maybe the transfer cost is lower for local products.
Yeah.
All right. So so in short, we have come to almost the end of our question and answer session. Looks like there is no more question on the screen with me right now. Okay, if you have any more questions, please type in the question box so we can help to address that. So in short, let me summarize these sessions. Leverage and inverse ETF are a new tool that were listed by Affin Hwang. Affin Hwang is the first issuer that issued the leverage and inverse ETF, and on the 29th of November, there were 4 leverage and inverse ETF listed. 2 are the leverage. One is on the US market on the FANG Plus index. The other one is on Chinese market, which is the Hong Kong Hang Seng China Enterprise Index. So the first ETF tracks 10 stocks, 10 US stocks, which I think most of us use like 7 out of 10 of these company services. The other one is the China Top 50, the China Hang Seng China Enterprise Index listed on the Hong Kong market. You can do whether 2 times leverage, or you can do negative 1 time, which is inverse ETF. If you think that US market is going to be bullish, then you can go into, sorry, not US market, the tech stock, the big cap stock of tech companies in the US is going to be bullish, then you can go into the 2 times leverage ETF. If you think that this tech stock is going to take a hit from probably trade war effect, maybe there's any changes to the trade phase 1 deal, maybe one of the presidents have some misunderstanding or row with the other president, so the trade deals got delayed, then you may probably go for inverse. For the Chinese market, again, of course, we can't really trade the Chinese market. If you want to have a magnified exposure to the Chinese market, we can go to the leverage ETF or inverse ETF on the Hang Seng China Enterprise Index, issued by Affin Hwang. All right. So there's yes, the recording will be available after today's sessions. So yeah, there's one more question. Is there any training on these products next year? Good question. We may have training on these products next year, but not sure if we can invite the issuer themselves. Today we are very lucky to be able to invite the issuer themselves to be on our webinar to tell you the products that they issue. We are thinking to arrange some, but no promise yet. All right, for any of this topic or inverse ETF. Okay, so the last question is, can you please show the Hang Seng component slide again?
Okay, let me go back.
Maybe you
want I think you are referring to Hang Seng China Enterprise Index because the 2 ETF that we have is on Hang Seng China Enterprise Index. So top 50, but I only show you the top 10. If you want the full list, what you can do is actually you can go to, you just Google Hang Seng Indices or Hang Seng China Enterprise. They actually publish a fact sheet once a month on the full list of constituents. So all 50 stocks of this index will be published on their website. So it's Hang Seng HSIL website, like Hang Seng Indices Limited website. All
right. So yeah, the inverse ETF were already launched.
It's already launched, yes.
On the 29th of November.
Yeah.
Okay, hope that answer all questions. So it looks like we have no more questions. So I think I've done a summary for today's sessions. So with that, I want to thank all of you for being a great audience on today's webinar, and this is the last webinar by Bursa Malaysia this year and managed by us, LifeChamp. I want to thank the speaker Lee Choo for spending your time with us today to tell us about what are these newly listed tools that we can use in our portfolio, be it to help us to gain a magnified return or be it to hedge our portfolio so that we can offset some of the losses from our existing equity portfolio. With that, thank you everybody for coming online. I will see you again next year. Okay, have a blessed year-end holidays, or have a blessed Christmas, and I heard you are going on a trip, so have a blessed trip. All right.
Thank you. Thank you very much for listening, and Merry Christmas and Happy New Year.
All right, Merry Christmas and Happy New Year. Bye bye.